Welcome to WorkSpan TV. I'm Ryan Johnson of WorldatWork. I'm in the studio today with Mike Halloran of Mercer, and the topic is trends in executive equity. The last couple of years have obviously been very volatile in the stock market. I'm curious about the trends that you're seeing with the use of executive equity. RSUs, options, what's coming, what's going. Can you just give us a brief answer about that?
Sure can. So let's talk about what's happened in the last couple of years. First is we continue to see this downward trend in the use of stock options. They're a very ineffective instrument in today's environment, too costly, too dilutive, and clearly not retentive when most options today are underwater most of the time given how up and down the market's been. So what are companies doing to replace that? There are several themes going on. One is there's continual concern about retention. And with that concern, the use of restricted stock has become a very powerful tool to help take care of that issue. At the same time, there's this continuing press from the outside world saying we'd like more pay for performance. So we are seeing a growing use of performance shares in the equation for executives. Now, what's a performance share? Basically, shares earned over a period of years tied to performance, typically financial performance of the company. And the number of shares you can earn can be higher or lower than what might be targeted, again, based upon where you perform over time within that span.
And my guess is that the proper or the appropriate usage or application of these three tools is going to vary considerably by industry and by maturity of the company, et cetera.
It varies dramatically. You're going to find it, as you mentioned, take financial services, a lot of heavy use of restricted stock, part of it's government mandated. You get into other sectors, however, technology used to be well known for options. Many have moved to time-based restricted stock because, again, of the volatility of options and also highly dilutive. And there's quite the war for talent going on in the technology sector, so they need to have a more dependable vehicle to get there. Beyond that, many other sectors have seen a growing use of performance shares. So you'll probably find 75–80% of the world in major companies in the U.S. now using performance shares.
So the use of options dramatically down in the last few years according to your data, or anecdotally as well, you're just not seeing it used as much?
It continues to decline both in terms of how many companies are using it, and then basically if you're using it, how much of it are you using? For those that are using options, it's rare to find it be probably more than a third of the package. It used to be 75% of the package 3, 4, 5 years ago.
Does that even apply in a place like Silicon Valley, which of course was built on the use of options?
Interestingly enough, that's probably an area that's run away from options faster than any other group. Again, for two things, the war for talent, a lot of movement of people. The technology sector is still pretty hot. You have a lot of these startups coming into the market that have very high valuations. Many are giving stock grants, not options. And the larger technology companies are fighting each other for talent, and they need to have restricted stock for retention reasons, if nothing else.
Mike, is there a formula or a targeted level of retention that some companies are seeking today with their stock?
Many have their own perspectives on these things. It often falls into several categories. You start with the type of maybe singular employee that you really can't afford to lose, the superstar, the technology star, what have you. You would find formulas or perspectives that we probably need to have as much as 2 times their total package in deferred equity or the like, serving as a very strong handcuff. Then you go to the next group of employee, the highly potential, highly talented type, where you want to send them messages, but also make sure that the competition doesn't take them away right when they're beginning to enter the prime of their ability to impact your results. For those types of employees, ranges of handcuff amounts, primarily through restricted stock, even deferred cash, could be somewhere between 1 to 2 times their annual cash compensation. Now, those kinds of formulas are going to vary by company. It's also going to vary by what else you have in the package that might be holding on to them and the like. But those are the kinds of things that people think about when they look at, do we have enough holding power on a given type of talent?
Are you seeing companies go to deferred cash?
Some, not a lot. Equity is still the preferred tool, linking to shareholders and the like, pretty important. But for some companies where one, they're a little bit strapped for the number of shares they have, or second, as we all know, many employees feel cash is king, it's dependable, the numbers won't change, that some have used that as a way to help retain people.
Mike, how would a deferred cash plan work?
Often the same as you find restricted stock, other than cash as the instrument. So rather than giving you $100,000 in stock that will vest in 3 years, at the end of the 3 years, that $100,000 of shares may be worth a little more, a little less. Instead, I promise you $100,000 in cash at the end of 3 years.
So Mike, just look into your crystal ball here for a second. I know we've got a really volatile market. We've got a regulatory environment. We've got Congress's attention on this issue. What do you think is going to be happening in the next, say, 12 to 18 months?
I would predict probably the following. One is, again, even fewer companies using options for the reasons I just cited. Secondly, because of concerns about retention, at least as much restricted stock being used, if not a little bit more. And on the performance share side, most will keep their plans. The big challenge in today's economic environment is setting those long-term goals against which to perform. Because of that, it's very tough to do these days. So some are lightening the weight on it, or at the same time maybe just setting goals with a little wider performance range.
Well, Mike, I want to thank you for talking with us about executive equity compensation trends. And for World at Work and WorkSpan TV, I'm Ryan Johnson.